The precious metal gold could be hitting 1120, even 1150 by year end. That's the words of my next guest, Jordan Eliseo of ABC Bullion. Jordan Eliseo, welcome back to Dukascopy TV. It's a pleasure to receive you again.
Thank you very much for having me on again.
Not a problem at all. Okay, so let's take a look firstly, obviously, at gold. Have the terrorist attacks over the weekend really pulled gold back to being that safe haven status?
Look, in the first sort of few hours of Monday morning, yes, gold prices did get a little bit of a boost in the aftermath of the sort of really terrible news out of Paris. But actually, ever since then, we've actually seen gold prices continue their recent trend weakening. And as we speak now, gold's trading around the sort of USD $1,065 an ounce mark, so pretty much at the year lows. So over the last few days, no, there hasn't really been any kind of safe haven appeal for precious metals.
I wanted to touch for a moment on metals versus miners. If we look at shares in gold miners, they've broadly trailed the actual bullion prices over the last year. Why is it that investors are happy to flock to bullion in these instances of looking for a safe haven or looking for a positive investment, but not so much the miners and the companies that produce that bullion?
Yeah, look, it's an interesting question and one that we get asked by investors a lot. I think it's, that underperformance of the miners versus the metal is not just something that's occurred this year. If you actually look at the sort of entirety of the last 15 years, gold has outperformed. And look, there are a number of reasons for that. Obviously, when you're buying into a mining company, potentially you're entering a fantastically profitable investment, but you're also taking a lot of other risks. You're taking management risk, you're taking a sort of counterparty risk. You also take the chance that your mining equity investment is just going to get caught up in broader equity market sell-offs and the like. When you're buying gold, you're buying an asset that's uncorrelated to financial markets. You're buying an asset that's highly liquid and tradable all around the world. And perhaps most importantly, you're buying an asset that has zero counterparty risk and infinite duration. So whilst gold and gold mining companies would seem to be in the same sort of mix as an asset class, they actually couldn't be sort of further apart on the risk-return spectrum. So, more prudent investors that are looking to diversify and protect the portfolio will tend to stick with physical bullion.
We've touched on the Paris terrorist attacks, which naturally are a short-term event, but in terms of longer-term events that gold investors have been concentrating on, it's really been that much anticipated possible December rate hike from the US Federal Reserve. But is that really sort of the only driver that we're seeing at the moment for the precious metal?
In the last sort of few weeks since the middle of October, absolutely it has been. So gold had sort of pushed almost back towards USD $1,200 an ounce only a few weeks ago. But the language that's come out of the Fed, of course, that very strong non-farm payrolls print a couple of weeks ago, that has completely changed the market mindset in the last few weeks. And as it stands right now, the chances of a rate hike for December are almost completely priced in. US dollar's been incredibly strong, and that's of course been the reason for gold prices weakening over the last couple of weeks. And really that dollar strength has been the major story behind gold weakening over the last few years, really since the interim peak back in sort of August, September 2011. As for the sort of long-term drivers, though, there are a lot of other factors: financial market volatility, the potential return of inflation, which is still quite low right now. Should there be any extra sort of sell-offs or volatility in the stock market? All of those things can change the spectrum and change the mindset towards precious metals. So I think we're in a very difficult period for the metals market right now. Long-term, though, I still think the secular trend is intact and that gold is a good investment.
So if we take into account then that USD strength, as you've just mentioned, there's also been some discourse surrounding Chinese new demand as well. How is all of this being priced into perhaps your year-end forecasts?
Yeah, look, if I was to put a sort of end 2015 target on gold, I think there's a chance we will actually bounce back up towards the sort of 1120, maybe even as high as 1150 mark, assuming the market can hold where it is now. I think if you look at the latest data out from the World Gold Council, if you look at central bank buying, sort of demand out of China and India, all of that is relatively robust. The big, I guess, sticking point or roadblock in the way of precious metal prices recovering is this uncertainty around the Fed and this rampaging US dollar, which has seen commodity prices crash to pretty much the lows of all the way back to the turn of the century, which is causing huge problems in emerging markets. So I think once the Fed does get that first rate hike out of the way, it'll probably be good news for precious metals because it'll actually sort of remove a little bit of uncertainty.
Jordan, many thanks for the update.
My pleasure, anytime.
The US Fed certainly continues to heap pressure on the precious metal. That is all we've got time for right now, but I'll be back with plenty more exclusive interviews for you right here from the heart of the APAC region. Goodbye.